Okay, how to pay off your home loan quicker. Let's look at number five, investing and debt recycling. So, if you've ever saw an ad online, social media about paying off your home loan 10, 15 years, or maybe even just paying off the total home in under 10 years, a lot of the time it is a result or what they are spruiking or advertising is debt recycling or investing. Okay. So I'm going to try and explain this to you as easily as possible, but it is can be a little bit tricky to get your head around. I'll also try and explain just some of the ways of their what some of these other people that what the actual strategies that they're spruiking, how it works, and we might even discuss just a little bit of the risks, issues, things to consider about it. Okay, before jumping into those types of things. All right, so investing in debt recycling. Okay, let's first start with the just explaining a couple of terms to you. Okay, so equity in your home. Okay, the amount of equity that you've got in your home is easily explained as if you were to sell your house, what would be left over? Okay, in this example here, so our home is worth $1 million. Our current home loan is 600,000. Therefore, we have equity of $400,000 in that home. If we went and sold it tomorrow for $1 million, we'd pay off the $600,000 home loan and we'd have 400,000 left over. Now, investable equity or usable equity, I prefer investable equity, is the amount of equity that we've got that we could use for, say, investment purposes. Okay, and how we calculate what investable equity that we've got is we first have to calculate what an 80% loan to value or LVR ratio is of the home. Now, the reason we calculate it based off 80% is because with an 80, if you owe more than 80% on your home, you would usually be subject to what's called lender's mortgage insurance. So if the loan is too high or too close to the value, you can take loans out for that, but it'll be more expensive as it's a higher risk loan. So investable equity usually means that, okay, in this above scenario, we've got 400,000 in equity, but if you want to keep that home and you want to take out another loan to invest, you're not going to be able to borrow that whole 400,000. You would borrow the difference between your home loan and the 80% mark. So for the same home that's worth $1 million, we first work out the 80% value, so 800,000. So that's kind of the max limit we can go to with the loans without being subject to mortgage insurance, without being subject to more terms and conditions and more hoops we've got to jump through, and requirements, and potentially, higher interest rates paid on those loans because they're higher risk. So at 800 our loan, we could take it up to 800,000. We currently owe 600,000, so that gives us $200,000 of investable equity. So we could approach our lender and say, we owe 600,000. I'd like to increase that loan 200,000 or take out another loan for 200,000 and invest those funds. So the investment could be anything. So it could be another investment property, could be shares, things like that. Could be just a term deposit if you want to lose money, because as we've already discussed, the interest rates are lower. But essentially, it's using that equity or the investable equity that you've got in your house to then make a better return. So the 200,000 that we're paying at 6%, maybe we can invest that 200,000 and make, in the loan, we're paying 6%. Maybe we can invest it and we can make 10%. Okay, and we potentially pocket the 4% difference. So essentially what you're doing with investment is you're trying to make a bigger return. If you're using it from debt, you're trying to make a bigger return than what the debt was from. Now, what debt, that's simply just the investing. What debt recycling does, it takes that one step further. Okay. So you may start with the $200,000, $200,000 that you've invested, and you make your 10%. So first year you make $20,000. I'm going to draw two loans here. So we're going to have the non-deductible debt, which would be the 600,000 you're starting with. And this would be the deductible debt, which would be that 200,000. If we are taking another loan out for 200,000 and we are using it to invest to make an income, then we're able to claim that as a tax deduction. Okay, so I make the $20,000 here from that 200,000 I've invested. And what I do is I repay that to my non-deductible debt. And maybe I've made scheduled interest, the basic repayments over that year for that deductible debt. And maybe my house value's gone up. So now what I can do is I can then borrow this money or increase this deductible debt loan. Okay, then maybe I've got 200,000. Maybe I've been able to increase it to 200,000. And then the next year I make another 10%. I make 25,000. Okay. And then what I do is I take the 25,000 and I go and push it back into my non-deductible debt. I've made scheduled repayments, and lucky me, my house has increased in value again. And then I go back to the bank and I increase my deductible debt. I increase that limit. And now I have 300,000 and I make my 10%. So I've made 30% for that year. And the 30,000 for that year, and I go and push that back into my non-deductible debt to pay that loan down. So that loan is going down. Okay, while this loan is increasing, that one's going down. And it's going down faster if I've made an investment return that's higher than what the interest rate has cost me. My property value goes up and I'm able to increase that deductible debt loan. And again, I come back and I've increased that loan again, that investment. And now I've made 35,000 that year. And again, I go and I push that back into my non-deductible debt to pay that down. And again, I can increase that. So if you can see what we're doing here is we are borrowing, we are essentially changing, or we're reducing this debt at the same time we're increasing that debt. Okay. That's where we look at is that we are recycling the debt. Okay. That's where it looks as from debt recycling. We are increasing deductible debt and we are reducing non-deductible debt. And it's typically done through investment because the only way that you get deductible debt is if that is debt that's taking out for investment purposes. There's a couple of rules around it, but essentially it's the debt that's been used to produce an income is the terminology. So buying vacant land, you're not going to be able to deduct that debt. You're not going to have that tax deductible debt. Okay, so we're using the equity that got in the home to then go and invest. Returns that we're making, we're using those returns or the cash flows, dividends, rental payments to pay down the non-deductible debt. And as that's getting paid down, we're then going and increasing that deductible debt. So it might end up being that in 10 years' time, we still owe, maybe we still owe the 800,000 that we initially owed, because we owed 600 on our home loan. We increased it to 800,000 because we had 200,000 of deductible debt. But so totally we got 800,000. But when we started, we had 600 here and we had 200 here. And then after 5 years or 5 to 10 years or something like that, okay, we now owe 200,000 here and we owe 600,000 here. Okay, we still owe 800,000, but what we've done is we've recycled this debt. Okay, we've been able to pay this side down quicker, but we've increased this side here to give us that tax deductible debt. Increased it. All right, now most of the ones that we see, or most of the or the biggest example that we see of this type of investment that is often put out there. It can work in shares and things like that as well. Works quite effectively because shares are paying dividends, regular income. As soon as you buy it, it's cash flow positive. So you've got income that can be used to pay down that non-deductible debt. But a lot of people do use it to purchase investment properties. Okay, and that's where you're mostly seeing it advertised. Pay off your debt in 10 years, yeah, those types of things that you see over social media. What they're doing is they're using that investable equity. Okay, they're going and purchasing investment property. It may be positive geared with rental income. Probably won't be initially because interest rates are too high now, and yields, rental income off investment of residential properties anyway, is not typically that high. So it may or may not be positive geared, cash flow positive, to give you more cash flow to go into here. At some point it will be. So extra cash flows can go in to pay your non-deductible debt down. You've used that to take out a bigger loan, maybe that 800,000 against that security, but you've then purchased, what that has gone into is that you've bought an investment property for $500,000 and you've got a loan of let's just say 325 loan here because you've had some purchase costs. Used the 200,000, you bought a $500,000 investment property. You've now got another loan for 325. So your total loan in deductible debt is 525. The 25,000 I've just added is stamp duties. Now you've got a deductible debt of 525 and you still owe 600 here. Okay, rental income that comes off this property is then used to pay back into the non-deductible debt. Maybe if this all goes well, and your house increases a lot, then you can go buy a second investment property, do those types of things. And then if we think about where we actually pay the house off faster, because if there's not a lot of cash flow coming in from the rent, with obviously there's rates and other things we've got to pay for, but there's not a lot of cash flow coming in to pay your deductible debt down. It may not reduce as fast. But what the strategy could be that, okay, well, in 10 years' time, that this house that you bought for 500,000 has increased. And maybe that it's gone up to $800,000, $900,000. And you're able to then sell that house for $800,000 or $900,000. And then that would give you an injection back that you could use. Then you could sell that property and then you could pay down your home loan. It's a bit messy on this page, but let's have a look at yeah, so say we bought for 500, okay, and then in 10 years time, that's worth 900. Okay, your loan on that property, if you're only paying interest only, still 500. Okay, but you've got 400 of gain that you can go back and pay off your home loan. And because you've been making scheduled repayments over the 10 years, your 600 loan initially was then paid down. So yeah, maybe it might only be 400 at that time, just with your normal repayments that you're making on your home. And then so that home loan is essentially now zero. You The one figure to look at is we'd have to less tax out of this, okay, and expenses. But yeah, essentially then you could pay that down. And that's really how the strategy works that they're talking about on social media. It's increasing your debt to buy more assets which can produce income to help you pay your loan down, extra income to pay it down, which you could then debt recycle. Similar to the offset accounts that we used, where we're using the cash flows, or we have the offset linked to our home loan. So it was helping us reduce the interest. The cash that was sitting there was helping reduce the interest. Essentially, that's kind of like a debt recycling because you're using that investment debt to reduce the non-deductible debt. Okay, and then that investment, whether it be a property or whether it be shares, has gone up in value, and then that could be sold off and pay that home loan off a lot quicker. The caveat to that, obviously, the risks involved in that is number one is that you're increasing your debt, so you've got a larger exposure to things. If you, yeah, in this example, you owe 600,000, you increase it by 200,000, then you buy a house for 500. So you've now ended up with 1.1 mil of debt. You've got more property exposure, but you end up with more debt. So you've got to be able to service that debt. The risk on a residential property is that if the interest rates are like with the interest rates at 6%, a residential property interest, like the rental income is usually around 5%, then you've got to less some fees out of that. You might only be getting sort of 3% yourself. You're paying interest rate at 6%, you're getting 3% net income. So it might be cash flow negative where you're having to actually pay more money into that investment property to keep servicing that loan. You could have that interest only loan so that the cash flows work out a little bit better. But then your hope would be that obviously your rental income would increase over over the years. And then maybe initially you have to top it up. Maybe it costs you a little bit of money you got to put into to service the debt on that. Um, but then in 5 years, 6 years, then the rent's increased, and now it's actually paying for itself completely. It's not taking any money out of your pocket. Um, but then you've also got capital growth. So if then the house has been a good investment, and it's got that capital growth, then obviously you're potentially in a larger position, and you've got more equity. That's equity that investment property could then be sold and paid off your house. Or that equity could be used to go and purchase another investment property. And then you could essentially continue on and do that. The one thing I just look at is that there are risks, obviously, taking on more debt, things like that. If prices do come off on any asset, then uh, yeah, you could be in a position where you essentially owe more than what your debt value is. You've got the cash flow issues, which I explained, just because the rental, especially now with interest rates being higher, the rent may not cover the interest on the loan plus all the expenses. So you'd need to make sure that you had extra or surplus income to service that investment loan. And then the other side, just obviously, if the growth doesn't, if you don't get as much growth in the investment over the 10 years, that you might not be able to pay that. You may not have that. Maybe this only goes up in this example here. Um, like maybe that only goes up 600,000. Maybe it only goes to 600,000. You haven't made as much, so you've still got you've still got a large debt on here. Um, so this is obviously all caveats with any type of investing, that you've got the risk that prices don't go in a straight line. It's not you just buy and it's going to continue to go up. There will be periods where it does decrease, things like that. So you've really got to do your own research and for what you're investing in. And the biggest thing I think about with this strategy is, yeah, because you're taking on more debt, it is a more aggressive strategy. So you've got to be, you do have to have a little bit more appetite for risk. And also that you've got to is really around the cash flow. So just making it, if you're buying, if you're then going to borrow more to invest more, you've got to have the income, the surplus income to be able to service that debt. Okay, the strategy can work and works quite well and has worked quite well for a lot of people. Where it doesn't work is that people that interest rates have gone up and now they have to chip in some money out of their own pocket and they don't have it. Or maybe if they bought the investment property, the tenant's not there, or the tenants they've lost a tenant for a while and they have to spend money, or maybe there's big maintenance things to do and they have to tip more money into it and they don't have the funds to do that. So it's really just about being, obviously, you're not borrowing to your maximum limit, and you're not putting yourself in a situation where you don't have any sort of reserves in cash and reserves in your cash flows. If you're doing this strategy here and you're getting a rental income and it's going to cost you an extra 15,000 a year out of your pocket, and that's all your savings is 15,000 a year, then yeah, it's probably not the right strategy for you. Or you probably need to downsize it. You need to buy something, an investment property for a lower amount. Or maybe you need to look at shares, doing something like that in shares initially, which can be lower cost, those types of things. Um, then you're purchasing the house with that. So the best way to do this, obviously, is just to get advice. Uh, you would see a financial planner such as myself, where you would get, we would lay out um, all your modeling, all your projections, and well, we can't give you advice around the actual property that you're purchasing. Like that would be a real estate agent or a buyer's agent, and you would definitely be encouraged to do your own research there as well, to make sure what you're buying is sound and that it is going to work for you and is going to get you some growth. And then we would come in and we would have a look at, we would do this type of modeling where you're looking at your cash flows are where they are now with your loans, things like that. Um, how much surplus you've got, and then we would build in that. Okay, we're looking at increasing our debt, and we're looking at buying this investment property, and then we'd make some assumptions around growth, some conservative assumptions around growth and around income and things like that, making sure that you can actually afford, that your cash flows are sufficient to afford that. Make sure you've got some buffer in there. And then just round out the strategy, make sure that the strategy is actually going to work. So, hey, yes, if we did do this and we bought this property and let's say it only grew this much a year, over the next 10 years, then is the strategy actually going to work? Is it going to work for us in what we are trying to achieve? I usually, when people come back to me and they've got an issue, or they're not sure if they can afford, they don't know what to do. With interest rates now being high, a lot of people are looking at, yeah, maybe we need to sell our investment properties, because of that cash flow is not as good. or because it's pulling money out of their pocket. A lot of the times, the ones that just haven't had that sound planning initially, um, to really look at things and go through that financial modeling, what it looks like, how it's going to work, using conservative figures to make sure that it's the strategy is going to work, um, and that that it's going to be the right strategy for them, to make it work. The same as with any investing, like if you were just investing for 12 months or something like that, well, or 1 or 2 years, like your biggest risk is that first couple of years. You buy in, it's the wrong time, something goes wrong, COVID hits, the GFC happens or something, the investment goes down, you're expecting to use that money for something like, yeah, we just need to build that plan to make sure, okay, yep, that if things do change, are we still going to be able to hold it? If interest rates go up a lot more, are we going to be able to afford that? If interests go up more and rates go down and property values or investment values go down, are we going to be forced to sell and take a loss? Or do we have the capacity there to keep funding that and to stay in there for 10 plus years? And that's really the key, because it could be the difference between you have to sell now and then to get out of that situation because you can't afford it, and prices are depressed at that time because there's other people in that same boat that everyone's jumping for the exit at the same time. And then, okay, well, versus we've done the right planning, um, our plan is sound, we're not being too aggressive or we're not running too tightly to close to our maximums. So we can buy ourselves time. Things change, the market changes. Okay, yes, that's changed. Maybe our strategy changes, but we don't have to make any rash decisions right now, sell everything off. We're able to cope and bide our time. And then yes, okay, maybe if we do get a bit of a dip, then but over the longer run, um, values are going to recover. Interest rates may settle down. Those types of things, we're going to be able to afford that. So it's really just building in, making sure that our planning is sound, that copes for those losses. But yeah, investing in debt recycling, it is a good strategy to pay off things earlier. Essentially, as I said, this equity which would just be sitting in your house, not really doing anything, because your house, yes, it might be going up in value, but it's not producing you an income. Um, we're seeking to take the funds out of that house or the investable equity out, put it into another investment. That other investment then could be used, if we've got extra cash flows, to pay our home loan down each year more, and we could then go and increase it. Or we get capital growth out of that investment, and then at some point we're able to sell that sell that investment, realize a large capital gain, and pay off our debt a lot quicker. Just important, if we're looking at this stuff, make sure we get proper advice. See a financial advisor, and it doesn't have to be me, but see someone that's going to actually run the modeling for you, and talk about sort of the worst case scenarios, that if things don't go right, make sure that you've got a plan there. Make sure that your cash flows, can afford it, and that and that you have that, and that you've got that more aggressive, or, or you've got the appetite or the risk tolerance capacity, um, to see the strategy worked for you. Make sure you don't make any the wrong decisions on those types of things, or get yourself into a situation where you're kind of backed against the wall, and um, you know what and you have to make a rash decision, on something. Hopefully that explains all that, and that gives you a good idea, a good understanding. And yeah, when you're seeing some of these adverts, on social media, that you know what they're kind of talking about, you know the angle, the strategy that that they're looking at and that they're doing.